Welcome to the deep dive. We take complex sources, break them down, and pull out the insights you need.
And today, we're tackling a really provocative question.
Yeah, from the latest special service newsletter from the Macro Butler,
That's right.
Fed rate cuts, magic trick, or market trap. Kitschy title.
Very. And timely, too.
Absolutely. I mean, that recent Fed rate cut, everyone saw it coming, right? The market's basically yawned.
Uh-huh. Priced in for sure.
But the newsletter argues there's way more going on beneath the surface. So let's unpack this. Is the Fed being clever here, trying to steer the economy? Or is this, setting some kind of trap?
That's the core tension.
Our mission today. Dive deep into this newsletter, pull out the key forecasts, the market takes, the history, basically help you understand what this really means.
And what's fascinating is how this source really challenges the standard narrative. It's not just reporting the cut, it's questioning the whole premise behind it.
Okay, let's start with the basics. The Fed's actual move. The newsletter gives some pretty interesting context.
Right. So the headline is 25 basis points cut. Fed funds rate down from 4.50% to 4.25%. Standard stuff.
But here's the kicker, according to the source. This is the second longest wait for a rate cut since the 1970s.
Yeah, it's a long pause.
And think of the last time we waited this long. 2001, 2002. What was happening then?
Well, markets were tanking, consumers were tapped out, inflation was nowhere to be seen.
Exactly. And now?
Yeah.
Not so much the case, right? The economy looks quite different.
Completely different. And you even had dissent within the Fed. Stephen Murin apparently wanted a bigger cut, 50 basis points.
Which signals some internal disagreement right away. Okay, so what about the Fed's own crystal ball, their forecasts, the SEP?
Ah, the summary of economic projections. Yeah, this is where it gets, let's say, intriguing. The Fed now sees inflation hitting its 2% target, wait for it, by 2028.
2028.
Seriously. Yep. The Macro Butler points out that implies 7 straight years of inflation running above target.
Wow, and that's after years of it being too low, right, from 2012 to 2020.
Exactly. 9 years of undershooting then, 7 years of overshooting now. Quite the flip.
Okay. What else did the SEP, GDP, jobs?
They lifted their GDP forecasts for 2025 through 2027. Unemployment, mostly unchanged for next year, but they see it looking, quote, slightly sunnier for 2026 and 2027.
Slightly sunnier, okay. And inflation measures, PCE.
PCE and core PCE projections were mostly unchanged, just a little nudge higher in 2026. So basically they're saying growth looks okay, jobs look okay, but inflation is still going to be sticky.
So they're cutting rates while expecting inflation to stay high for years. That's the magic trick part, maybe.
It certainly raises eyebrows. And the dot plot, where each member puts their anonymous rate forecast, adds another layer.
Right. What did the dots tell us?
Well, the 2025 plot got trimmed a bit. One dot, probably Mirren, seemed to be calling for 5 cuts next year.
5 cuts, wow. But others disagreed.
Big time. Looking at just this year, among the 19 members, 7 see no more cuts, 9 see 2, 2 see 1. Oh, and 1 actually sees a hike.
A hike. So they're all over the place.
Pretty much. The source dryly notes the math makes sense somehow. For 2025, the median forecast was trimmed from 3.9% to 3.6%. So after the 2 expected this year, maybe just 1 more cut next year.
Okay. And further out?
5 members see rates below 3% by 2026. For 2027, the forecast is trimmed again to 3.1%. All told, that's about 125 basis points of cuts from September 25 to the end of 27.
Which, the newsletter points out, is way less than some wanted. It uses that phrase, the manipulator-in-chief turned central banker, saying he wanted 300 basis points, like yesterday.
Yeah, the source definitely doesn't pull punches with its language there, clearly framing a critical view.
So how did the Fed actually communicate all this, the official statement?
The FOMC statement, the source calls it a classic Fed compromise, Cut rates, hint at more cuts, talk up the economy's strength.
And then casually mentioned inflation might stay high.
Exactly. The newsletter likens it to saying, yeah, the house is on fire, so we're making matches cheaper.
Uh-huh. Okay. And meanwhile, they're still shrinking the balance sheet, that huge pile of bonds they bought.
Yep. Still trimming $5 billion a month from that $6+ trillion mountain. The analogy used is chipping away at a mountain of IOUs with safety scissors.
Gives you a sense of the scale. Slow going. What about the press conference, the Fed chair's explanations?
Well, the source, again, uses that provocative label, the manipulator-in-chief turned a central banker, to describe the chair. He apparently got pushed on why cut rates if the Fed's own forecasts show inflation staying up.
Good question. What was the answer?
He pinned it on downside risks to employment and weak housing activity, risk management, basically. But then he had to admit, yeah, inflation is still expected to rise.
So manage the risk of slower growth by cutting rates, even if inflation is still a problem.
That seems to be the rationale presented. He apparently downplayed support for a bigger cut, didn't mention tariffs, but did concede goods prices are pushing inflation up before saying the threat had somehow eased.
A bit of a verbal dance then.
The source calls it the classic central banker magic trick. Cut rates, promise growth, downplay risks all in one breath. And apparently his tone was noticeably more dovish this time compared to the last cut back in September.
Okay, so that's the Fed's move and their story, full of, let's say, interesting nuances. But the big question is, how did the markets react to this magic trick?
Right. Did Wall Street buy it? The Macro Butler says the market barely flinched. It was so well telegraphed.
So no big surprises.
Not immediately. The Dow Jones, it says, strutted back above 46,000. The NASDAQ, though, sulked a bit, down for a second day.
Interesting divergence. What about expectations for future cuts?
That's where the dovish tone had an impact. Money markets are now getting on more than 2 additional cuts before the year is out.
So they heard the dovishness loud and clear. Dollar, gold, bonds.
The dollar did a wild U-turn, dropped on the statement, then recovered to end flat. Gold had a roller coaster session, spiking, then drifting lower. And bonds barely moved. They'd long priced in the rate cycle restart.
So on the surface, maybe not huge drama. But the newsletter sees trouble brewing.
Definitely. It highlights this looming headache for the Fed. The possibility of rising inflation and rising unemployment happening at the same time.
Stagflation.
Exactly. The source uses the term Trump stagflation, pointing to a potential scenario of rising prices and vanishing jobs. It suggests the once risk-free Treasury is becoming anything but.
That's a pretty grim outlook. Does history back this up? This idea that rate cuts aren't always good news.
Well, this is where the newsletter really challenges conventional thinking. It says Wall Street often treats the Fed like some kind of wizard who can just conjure a soft landing.
But reality is messier.
Reality keeps barging in uninvited, as the source puts it. It looks at the Fed funds rate versus the ratio of the S&P 500 to the price of oil.
Okay, what does that show?
Historically, it suggests that every rate cut is basically the Fed hollering, dinner's ready, to the bust cycle. That ratio tends to shoot up, then nosedives like a kamikaze seagull straight through its 7-year moving average.
Whoa. So cuts signaled the start of the downturn, not the end.
That's the argument. A significant market shift, not stabilization. The soft landing might be more illusion than reality.
That turns the usual story on its head. What about jobs? We usually think rate cuts help employment.
Yeah, that's the common beliefs. But the source argues, historically, every time the Fed starts cutting rates, it's not the all-clear signal. It's usually the moment unemployment starts climbing.
Really, unemployment goes up after cuts.
That's the historical pattern presented. The odds of this time being different, according to the newsletter, are like finding a diet plan where you lose weight eating cheesecake for breakfast.
Okay, so not great odds. Is there current evidence for this job market weakness?
The source points to data from last August. For the first time since 2021, there were actually more unemployed people than job openings. 7.24 million people looking for 7.18 million jobs.
The gap closed, and not in a good way.
Right. And companies, they're cutting costs, citing taxes, regulations, sticky inflation. They're bringing in AI, outsourcing.
So jobs are being replaced or just not created.
It leads to employers pulling back on expansion, workers feeling the squeeze. And the source is critical of typical political fixes, more regulation, taxes, wage mandates, saying they often just make the patient sicker.
Okay, so if rate cuts historically line up with rising unemployment, what does that do to overall economic well-being? What about that misery index?
Yes. The misery index, just adding the unemployment rate and the inflation rate together.
Simple but telling.
And according to the Macro Butler, history shows that every time the Fed starts snipping rates, that index, it doesn't go down. It shoots up.
Shoots up. So more misery after rate cuts.
That's the historical correlation highlighted. The analogy used is pretty stark. It's like Jerome Powell handing you an umbrella just as the hurricane makes landfall.
Ouch. So the intended relief doesn't actually materialize for the average person.
That's the core argument. It suggests the cuts might actually precede more economic pain, not less.
This leads to a fundamental point the source makes about who the Fed really serves.
Yeah, it's quite blunt. It says, Everyone pretends the Fed cares about Main Street, but the only street it has ever protected is Wall Street.
Strong words. How does it back that up?
It points to the press conferences, starting with talk about the American people, but then quickly focusing on market stability, market reactions, a love letter to the markets, as they put it.
And how does this play out in specific market mechanisms, like the yield curve?
Right, the yield curve, that difference between long-term and short-term interest rates, usually the 10-year versus the 2-year Treasury yield.
What happens there when the Fed cuts?
History suggests that when cuts begin, the yield curve stops playing limbo and starts climbing. It steepens. And it typically peaks only once the Fed funds rate hits its bottom for that cycle.
So the curve steepens after cuts start. Interesting. What about the Fed's control over different rates?
The newsletter argues the Fed can control short-term rates pretty effectively, like playing Mario Kart, mashing the buttons.
Okay.
But long-term rates, the 10-year, the 30-year, the ones that really affect mortgages, car loans, business investment,
Yeah.
those are set by the market. The source implies the Fed chair has about as much control over those as over the weather.
So limited power over the rates that matter most for the real economy.
That's the implication. And you see other disconnects, too, like inflation expectations versus bond yields.
What's happening there?
The source describes an alligator's jaw snapping shut. You've got U.S. five-year forward inflation swaps, basically. Market bets on inflation 5 years from now creeping up since April.
Okay, market expects more inflation down the road.
But at the same time, 2-year Treasury yields have been tumbling since mid-May, reacting to the expected Fed cuts.
So short rates down, future inflation expectations up. What about long-term real yields?
They've stayed stubbornly high, the source says, made worse by political stuff like departures from the Fed board.
Got it. And government spending. Does the Fed have any sway there?
The White House might be nudging the Fed to cut, but the newsletter argues the economic backdrop actually screams for higher ones.
But the Fed cuts anyway.
And the source contends the Fed has about as much influence on government spending as a traffic cop has on a stampede. Interest payments on the debt are just going to keep ballooning regardless of the Fed funds rate.
Okay, so lots of disconnects. Let's bring it down to the company level and the consumer level. How do rate cuts typically affect corporate profits?
Counterintuitively, perhaps. The source argues cuts are less a victory lap and more a distress signal. Historically, they tend to correlate with weaker earnings, not stronger ones.
Weaker earnings after cuts start.
Yeah, earnings per share often sink until the Fed finally dusts off its courage and starts hiking again.
Wow. Okay, so if earnings weaken, what happens to stock returns overall?
Predictably, they tend to suffer. Once the Fed starts cutting, equity returns often go from, lively to muted, and then often slides straight into the red.
The source calls it Wall Street's version of a hangover.
Apt description. It suggests the party might be ending when the cuts begin.
Does this affect all sectors equally?
No, there's usually a rotation. The newsletter points out that when the Fed cuts, energy producers think big Dow Jones components tend to shine.
Okay, energy producers do well. Who doesn't?
Energy-hungry tech stocks, major NASDAQ players, often start sweating. The source thinks this rotation show has likely just begun.
Interesting. Any other sector notes?
Financials also tend to underperform the S&P 500 during cutting cycles. They're described as the canaries in the interest rate coal mine.
Makes sense. What about gold? You mentioned its roller coaster reaction initially.
Right. The cuts themselves might act as a short-term speed bump for gold's 12-month return. But the newsletter stresses its real drivers are bigger picture things: wars, geopolitical chaos, and global panic.
So gold's story is more complex than just reacting to the Fed funds rate.
Much more complex.
Okay, let's talk about the consumer, the engine of the economy. How do rate cuts impact the average person's spending?
Well, the newsletter paints a pretty bleak picture here. It says most Americans are living paycheck to paycheck, so the consumer economy can't really run on empty.
And the cuts don't help much.
Not for the average person, according to the source. Manufacturing is weak, businesses feel burdened, jobs are being automated or outsourced. Lower rates might help a big company buy back its stock, but for retirees, savers, small businesses, it's described as a joke.
So the benefits are unevenly distributed at best.
That's the argument. And the source gets really critical of the underlying economic theory here, the idea that lower rates are just a simple cure-all.
Yeah.
It calls that amoeba-level brain power if you ignore history. It points out the Fed cut rates aggressively during the Great Depression, during every recession after 2008.
And the result wasn't magical growth.
Nothing, the source says, except maybe propaganda dressed up as GDP. It argues that when the Fed chair attacks the Fed for not cutting enough, it's like pushing on a string ineffective and causing economic damage to ordinary people who believe the fairy tale.
Wow. Amoeba-level brain power. Pushing on a string. Fairy tale. The critique is sharp. It really paints a picture of policies disconnected from historical reality.
Deeply skeptical, yes. And it all leads to this prognosis the source calls.
Trump stagflation. Right. Let's unpack that. What does it mean, according to the newsletter?
It means rising prices, vanishing jobs, and a government that prefers economic growth on PowerPoint slides while reality quietly starves the middle class. The core idea is that cheap money isn't a solution. It's just a Band-Aid on a sinking ship.
So the old economic models are broken.
That's the claim. Keynesian theories are crumbling. That classic 60-40 stock bond portfolio, it's becoming a Wall Street museum piece. We've moved past financial repression into full-blown monetary inflation.
And in that kind of world, what works? What doesn't?
In a high inflation environment, the source argues bonds collapse in value. What thrives? Real assets like gold, prime real estate, and commodities.
Tangible things. What about stocks?
You need to be selective. Focus on large caps with pricing power companies that can pass on rising costs to consumers. The overall message is stark. Ditch the old playbook, load up on inflation hedges, and prepare for the storm.
Okay, so if you're listening, trying to navigate this as an investor, what are the specific recommendations from the Macro Butler?
They get quite specific. For gold and precious metals, they suggest investors arm 30–50% of their portfolio with physical gold and other precious metals such as silver, platinum, palladium, and key commodities. Things that are battle-tested and sovereign-proof.
30 to 50% in physical and commodities. That's a significant allocation.
It is. It reflects a strong conviction about inflation and instability. Elsewhere in the piece, they mention 25–40% specifically in physical gold for an inflationary bust, so a heavy weighting towards real assets.
Okay. What about the equity side?
Deploy capital into low-leverage firms with strong EPS and free cash flow. Basically, financially solid companies that can generate cash.
And that sector rotation idea?
Yeah, buy the dip in energy producers, but retreat from energy consumers when they rally. And with global tensions rising, they also suggest considering aerospace and defense stocks.
Makes sense in that context. Bonds, you said they collapse in value.
Long-duration government bonds, yes. The advice is to avoid them, too slow, and too exposed.
So what kind of bonds should you hold, if any?
Stick to short-term, investment-grade corporates maturing within a year, much less exposed to inflation and interest rate hikes. Plus, they offer liquidity.
Got it. And the overall expectation for investors?
Brace yourselves. Prepare for much higher volatility and likely dull inflation-adjusted returns in the foreseeable future. Don't expect smooth sailing.
This really comes down to a fundamental critique of how economics is practiced, doesn't it?
Absolutely. The source argues current theories are broken, precisely because they ignore these harsh truths like global money flows, debt dynamics, and the fragile power of public confidence.
Things that aren't easily modeled.
Exactly. Policies made by ivory tower academics with zero real-world experience are doomed to fail. Economics needs a reality check, not just another theory. The source uses another biting analogy. It's like a man penning a book on childbirth.
Lacking fundamental experience.
Right. And the core blindness, according to the newsletter, is ignoring cycles. Most investors and central bankers, it seems, still stare at the world like it's a flat line.
When reality is cyclical.
Everything is energy and runs in cycles, the source states. The day people in charge truly spot the cycle is the day they realize just how little control they have.
And this blindness isn't just one side of the political spectrum.
No, the source is critical across the board, saying both Keynesians and the right are happily steering the ship of state straight into the iceberg of their own propaganda because they refuse to check the actual facts and historical patterns.
So as we wrap up this deep dive, that core question remains. Fed rate cuts clever magic trick or dangerous market trap. The Macro Butler clearly leans towards trap, or at least towards Fed impotence against bigger forces.
Yeah, the picture painted is one of limited Fed power against deep-seated cycles, with Trump stagflation as a potential uncomfortable outcome. It really challenges you to look past the headlines.
It certainly does.
And maybe this raises a final thought for you, the listener. If these economic cycles are as real and powerful as, say, the seasons, maybe the goal shouldn't be trying to control them.
but rather,
Rather understanding them, preparing for them, knowing how they flow. Perhaps the real takeaway is to arm yourself with knowledge of history, of how real assets behave, instead of relying on, well, fairy tales, as the Course puts it.
definitely something to mull over as you watch the markets and the economy unfold. We hope this deep dive into the Macro Butler's perspective has given you a clearer, if maybe more critical lens to view it all through.